Imagine you're trying to balance two absolutely essential things. Making sure everyone who wants a job can find one, and keeping the cost of everything from groceries to gas from constantly climbing.
Yeah.
It feels like there's this fundamental tension at the heart of the economy, low unemployment versus stable prices.
Yeah.
Can we truly have both, or is there always, a trade-off?
That's the big question, isn't it?
Today, we're taking a deep dive into a core concept that has shaped how we think about this exact challenge, the Phillips Curve.
Exactly. And you've shared a fascinating stack of sources with us, articles, research, notes, that really dig into this relationship between inflation and unemployment, focusing heavily on the Phillips curve. Our mission in this deep dive is to unpack what the sources reveal. We want to understand where this idea came from, see how dramatically our understanding of it has evolved over the years, and most importantly, grasp what it tells us about the incredibly difficult choices policymakers face when steering the economy. We'll be drawing directly from the insights in your material to explore its history, the theory behind it, why that initial simple trade-off turned out to be anything but simple, and what it all means for things like interest rates and government actions.
Okay, so where does this all begin? We have to start with the person who first identified this relationship, A.W. Phillips. And this guy wasn't just an economist tucked away in an office, was he?
Not at all.
Your sources hint at a pretty adventurous past. He was a crocodile hunter, a movie director, even spent time as a prisoner of war in World War II.
He really did lead an extraordinary life before he landed at the London School of Economics. He even built this incredible mechanical device, the M&AC, using water flowing through pipes to simulate the economy, trying to bring economic theory to life in a physical model. It was quite something.
Right, that water computer is wild. But his most famous contribution, the Phillips Curve, came from purely empirical work, looking at data, basically.
Yeah, he meticulously studied data from the UK, looking at unemployment and wage inflation trends over nearly a century, from 1861 all the way up to 1957, just crunching the numbers.
And what did he find? What was the core observation?
Well, what he observed was compellingly simple, really. Across that long stretch of UK history, he found a consistent inverse relationship.
Okay.
When unemployment was low, wage inflation tended to be high. When unemployment was high, wage inflation tended to be low. It suggested a stable link between, how tight the job market was and how fast wages and subsequently prices were rising.
Your source material illustrates this beautifully with scatter plots. If you graph historical data points, like for the UK from 1950 to 2020, or even the US more recently from 2020 to 2022, you can sometimes clearly see this downward slope appearing.
Exactly. Periods with low unemployment clustered with higher inflation rates, and periods with high unemployment linked to lower inflation. It seemed quite clear in those specific periods.
And because Phillips's findings seemed so stable across nearly a century of data, it was quickly interpreted as, like, a solid, dependable menu for policymakers.
Right. That was exactly the thinking. The government or the central bank could look at this curve and essentially pick where they wanted the economy to be.
So a choice.
A choice, yes. Did you want to tolerate, say, 3% unemployment? Okay, the curve suggests that might come with 5% inflation. Or would you prefer only 2% inflation? Well, the curve indicates you might have to live with, say, 6% unemployment. It seemed like a stable, manageable trade-off.
And this wasn't just academic theory. This idea had and still has massive implications for the real world, especially for politicians facing voters.
Absolutely. Your sources highlight this explicitly by connecting it to political outcomes. Look at U.S. presidential elections. One figure in the material shows that, historically, the margin of victory for the ruling party tends to be significantly higher when inflation is lower.
That makes total sense. It ties directly into that famous line from Bill Clinton's 1992 campaign. The economy, stupid. Focusing on the recession and high unemployment resonated because jobs and income hit voters directly.
Definitely.
But the election data you shared shows that inflation also hits voters hard. Rising prices erode purchasing power, and people feel it directly in their wallets. It's not abstract.
It's understandable that policymakers and voters universally prefer both low unemployment and low, stable inflation. When we say low inflation, we mean prices rising at a modest, predictable pace, maybe around 2%.
Right, not zero or falling.
Exactly, not actually falling, because deflation is also deeply problematic, as we'll get into.
Which brings us to the core conflict that the Phillips curve, in its initial interpretation, seemed to embody.
Yeah.
You typically couldn't have both simultaneously. You were forced to make a difficult choice.
The anecdote about Helmut Schmidt, who was a super minister in West Germany back in 1972, an economist turned politician, perfectly captures this tension.
Ah, yes, this story.
Speaking at a rally, trying to appeal to miners, he stated, 5% inflation is easier to bear than 5% unemployment. He was signaling a preference, promising his party would prioritize fighting unemployment while keeping inflation contained.
Politically astute, right?
Absolutely. Appealing to the thousands of Ruhr miners in Dortmund. Smart politics.
But then, the very next day,
Right.
his own head of economic policy confronted him, saying, Herr Minister, what you said yesterday is false. Which is quite blunt.
Mm-hmm. Yes?
And Schmidt's response is so revealing about the bind policymakers are in. I agree that what I said was technically wrong, but you cannot advise me about what I decide is politically expedient to say to an election rally?
Wow.
This wasn't just a politician being cynical. It brutally illustrated the difference between what you wish you could deliver as a politician and what is actually feasible within the constraints of the economy as economists understood it at the time. So within that simple Phillips Curve framework, the economic reality was that more inflation was the unavoidable opportunity cost of achieving lower unemployment, and vice versa. You had to give up a bit of one goal to make progress on the other. It was a trade-off.
Which leads us to a deeper question. Why is inflation such a big deal anyway? We all intuitively understand why high unemployment is bad, lost income, social costs, all that. But what are the specific economic harms of rising prices? Why do people dislike it so much?
Your sources lay this out clearly. First, there's the issue of redistribution. Inflation unfairly penalizes people on fixed nominal incomes. Think about some pensioners who get a set amount each month in dollars or pounds or whatever.
Yeah, their income doesn't change.
But if prices rise steadily, that fixed amount of money buys less and less stuff. Their real standard of living falls through no fault of their own.
And it creates a significant redistribution between borrowers and lenders. This is a big one. If you borrow money at a fixed nominal interest rate and then inflation turns out to be higher than expected,
You win, right, as the borrower.
you do, in a sense. The real value of the money you pay back is less than the real value of the money you borrowed.
Right. The source uses the great example of Julia borrowing from Marco. If Marco lends Julia $100 at 5% nominal interest, expecting zero inflation, he anticipates getting back $105 with the same purchasing power.
Seems fair.
But if inflation hits 10%, the $155 Julia repays can buy less than the original $100 could. The real interest rate Marco earns is actually negative. He lost purchasing power.
Precisely. Inflation benefits borrowers with fixed nominal debt because the real burden of their debt shrinks. Conversely, it harms lenders who hold assets fixed in nominal terms, like bonds. In extreme hyperinflation, it can even effectively wipe out the value of nominal savings and debts.
And the Fisher equation you mentioned, nominal rate, real rate plus expected inflation, that highlights that what matters for economic decisions isn't the sticker price, the nominal rate on the loan, but the real rate, the return after accounting for inflation.
Absolutely, that's the economically relevant rate.
Beyond this redistribution, high and volatile inflation just makes everything harder, doesn't it? The source points out it injects tremendous uncertainty into economic decisions. Prices are supposed to be signals about relative scarcity.
Right, like is the price of wheat rising because there's a drought or just because all prices are rising due to general inflation?
Exactly. When inflation is high and unpredictable, the noise of the general price increase drowns out the signal of relative price changes. Firms don't know if a rise in their input costs is a genuine change in scarcity, requiring them to find alternatives, or just part of the general inflation noise.
Households don't know if a sale is a real bargain or just prices catching up elsewhere. It's confusing.
And this uncertainty hinders investment and efficient resource allocation. People hesitate.
And for businesses, there are also direct menu costs. Literally the cost in time, effort, and money to change price tags, update websites, update catalogs, reprogram vending machines, renegotiate supply contracts constantly. It's a real hassle factor.
Okay, so if inflation is bad, you might think falling prices, deflation, would be good. Cheaper stuff sounds great.
You'd think so, but deflation also has serious downsides. One is it encourages postponed consumption. If you expect prices to be lower next month or next year, why buy that new car or washing machine today? You wait.
And if lots of people wait, that reduces aggregate demand in the economy. Spending slows down.
Exactly, which can worsen an economic downturn. And just like inflation helps borrowers, deflation hurts them. It increases the real burden of debt.
The flip side.
Right. If you borrowed $100 at a fixed rate and prices fall by 5%, the $100 you pay back is worth more in real terms. This can make it much harder for borrowers to repay, potentially leading to defaults, bankruptcies, and even a financial crisis, especially if the economy is already heavily indebted.
So this is why economists and central bankers generally aim for a small, positive, and stable rate of inflation, often around 2%. Your source mentions it greases the wheels of the labor market. What does that mean?
This is a key point. In a dynamic economy, some industries grow, some shrink. Real wages need to adjust. If demand for, say, typewriters falls, maybe the real wages of typewriter repair people need to fall relative to others.
Okay.
But it's very difficult and unpopular to cut nominal wages. Workers strongly resist seeing their paychecks shrink. Understandably so.
Yeah. Nobody likes a pay cut.
But with a little bit of inflation, say 2%, real wages can effectively fall, even if nominal wages are stagnant or rise slowly, say by 1%. A 1% nominal raise when prices are rising by 2% means your real wage has actually fallen by 1%.
Ah, I see. It achieves the necessary relative adjustment without the shock and resistance of a nominal pay cut. People notice their paycheck going down, but they might not notice it not going up quite as fast as prices if inflation is low and stable.
Exactly. It allows for those adjustments more smoothly. And crucially, positive inflation provides monetary policy with more room to maneuver during a downturn.
Right, you mentioned this earlier, the interest rate thing.
Yeah, when the central bank needs to cut interest rates to encourage borrowing and investment, they cut the nominal policy rate. But the real rate is what influences decisions. Nominal rate minus expected inflation.
Okay.
If expected inflation is 0 or negative, the real rate can't fall much, even if the nominal rate hits the zero lower bound, ZLB, where it can't effectively go below 0 because people could just hold cash instead.
Makes sense.
But if there's 2% inflation expected, the central bank can cut the nominal rate to 0, resulting in a real rate of minus 2%, 0%, 2%. That provides much stronger stimulus. The ZLB constraint became very real after the 2008 financial crisis and is a major reason many economists defend a positive inflation target.
Okay, so we established why stable, low inflation is generally the target.
Right.
But how does the economy actually generate inflation or deflation? This is where your sources really dig into the underlying mechanism, the conflicting claims on output, and this idea of the bargaining gap.
Right. This gets to the theoretical plumbing behind the Phillips curve. This part of the story is built upon the standard labor market model, the one featuring the wage-setting curve and the price-setting curve.
Okay, refresh us quickly on those.
Sure. The wage-setting curve essentially represents the real wage that workers need or are able to claim at different levels of unemployment, ensuring they have enough incentive to work effectively. Their bargaining power is higher when unemployment is low.
Makes sense. Fewer available workers means more leverage.
And the price-setting curve represents the maximum real wage that firms can afford to pay while still earning their profit-maximizing markup over costs, given things like productivity and the level of competition in their markets.
Got it.
Exactly. The point where these two curves intersect represents the labor market equilibrium unemployment rate. At this unemployment rate, the real wage demanded by workers is exactly consistent with the real wage firms can afford while maintaining their desired markup. So there's no inherent pressure for real wages and therefore prices to rise or fall. Things are in balance.
Okay, so that's equilibrium. Now introduce the bargaining gap. This sounds like the key link.
It really is. It's the core concept linking the labor market state to inflation in this model. It's the difference between the real wage workers are effectively claiming, which depends on employment via the wage-setting curve, and the real wage firms are willing and able to pay, given their markup on the price-setting curve.
So it's about the fight over the economic pie.
Pretty much. Think of it this way. The total economic pie per worker is determined by productivity and also the cost of imported inputs, which affects how much is left for wages and profits domestically. The bargaining gap represents whether the combined claims of workers via real wages and firms via profits on that pie sum up to exactly the size of the pie, or more than the pie, or less.
Okay, so if unemployment is low specifically, lower than that labor market equilibrium rate we talked about, workers have more power. They can demand higher real wages.
Right. Their claim on the pie is higher. If the economy is operating at unemployment below the equilibrium, the real wage on the wage-setting curve is above the real wage on the price-setting curve. This opens a positive bargaining gap.
Meaning the claims exceed the pie.
Exactly. Workers' claims through higher wages, combined with firms' claims through their markups, exceed the size of the pie, output per worker. Something has to give.
And firms can't magically produce more just because workers demand higher wages.
Precisely. So firms react to rising labor costs by passing them on to prices to maintain their profit margins. But when prices rise, the real wage increase workers just got is eroded.
So they ask for more again.
Yes. Workers demand higher nominal wages again to try and restore their real wage target. Firms respond by raising prices again to protect their markup, and you get this wage price spiral.
Oh, okay.
This continuous upward pressure on wages and prices is inflation. The positive bargaining gap is the engine driving this inflationary pressure in the model.
And the opposite happens if unemployment is high, say above the equilibrium level.
Yes, that creates a negative bargaining gap. Workers have less bargaining power, they might accept lower real wage increases or even wage freezes or cuts in real terms. Total claims on the pie, wages plus profits, fall short of the output.
So downward pressure.
Downward pressure on wages and prices. This leads to disinflation, falling inflation rate, or potentially even deflation, falling prices.
And if unemployment is exactly at the labor market equilibrium rate, the sweet spot.
At that specific unemployment rate, the bargaining gap is zero. The real wage claims are consistent with what firms can afford and the size of the pie. There's no inherent upward or downward pressure from the labor market on wages and prices, assuming no other shocks are hitting the system.
So this labor market model with the bargaining gap provides the theoretical underpinning for the Phillips curve we started with. You can plot the bargaining gap, and thus the pressure on inflation, against unemployment.
Exactly. Low unemployment means a positive gap, leading to inflation pressure. High unemployment means a negative gap, leading to disinflation or deflation pressure. And the equilibrium unemployment rate, with a zero bargaining gap, corresponds to stable prices, zero inflation, in the simplest version of the model.
So this model explains why Phillips might have observed that relationship. It's fundamentally about the balance of power and competing claims in the labor market as unemployment changes. It provided a theoretical anchor for his empirical finding.
It did. It made sense of the observation.
But as we know, that simple picture didn't hold forever. The seemingly stable menu Phillips found started to shift, particularly in the 1970s. What was the missing piece? What went wrong?
This is where the really crucial insight comes in from economists like Milton Friedman and Edmund Phelps. They pointed out a major flaw in the simple Phillips curve thinking. It ignored the role of expectations.
What people think will happen.
Exactly. People aren't just reacting passively to current conditions, they are forward-looking. Their beliefs about future inflation significantly influence their wage demands and price-setting decisions today.
Okay, so how does that work? If workers and firms expect prices to rise by, say, 3% next year,
then they're not going to sit idly by. Workers will demand at least a 3% nominal wage increase just to maintain their current real wage, their purchasing power. And firms, anticipating their own cost rising by 3%, including those higher wages they have to pay, will likely raise their prices by 3% to maintain their desired profit margins.
right, become self-fulfilling.
Pretty much. So even if the economy is operating at the labor market equilibrium unemployment rate, where the bargaining gap from current conditions is zero, if everyone expects 3% inflation, then actual inflation will be 3%. Wages and prices will rise by 3% annually just to keep relative prices and real wages constant in line with those expectations.
So this means the entire Phillips curve shifts upwards by the amount of expected inflation.
Precisely. The zero inflation point is no longer at the labor market equilibrium unemployment rate. If expected inflation is 3%, then the 3% inflation point is now associated with that equilibrium unemployment rate. The whole curve moves up. Your sources, like figure 15.7, show this graphically parallel curves shifting upwards.
And this understanding completely changed the policy game, didn't it?
Completely. It revealed the immense danger of trying to maintain unemployment below the inflation stabilizing rate, that equilibrium rate where the bargaining gap is zero. If policymakers tried to keep unemployment too low, a positive bargaining gap would open up.
Okay.
So inflation wouldn't just be the expected rate, it would be the expected rate plus the positive bargaining gap inflation. Let's say expected inflation is 3%, and the bargaining gap at this artificially low unemployment level adds another 2% of inflationary pressure.
Then actual inflation jumps to 5%, 3% plus 2%.
Right. And here's the killer part. If people then base their future expectations on recent experience, what's called adaptive expectations, then in the next period, their expected inflation jumps from 3% up to that 5% they just saw.
Oh, I see. So if unemployment is kept low, maintaining that 2% bargaining gap pressure.
Then actual inflation next period will be 5%, the new higher expected rate, plus the same 2% gap pressure totaling 7%. The Phillips curve shifts up again.
Wow, it just keeps climbing.
This is the mechanism of accelerating inflation. It's not just that low unemployment causes high inflation. Trying to push unemployment below the inflation stabilizing rate for a sustained period causes inflation to continuously rise. There is no stable, permanent trade-off below that specific unemployment rate.
Yeah.
You can't buy permanently lower unemployment with just a higher level of inflation. You buy it with accelerating inflation.
Wow, so that wasn't just a minor tweak to the theory. That fundamental insight from Friedman and Phelps completely dismantled the idea of a stable, exploitable Phillips curve menu.
It really did.
Trying to pick a point below the inflation stabilizing rate wasn't a choice between levels of unemployment and inflation. It was a choice between an unemployment level and a rising rate of inflation. That is a massive shift in economic thinking.
It truly was. It redefined the long-run relationship. In the long run, unemployment tends to return to this inflation stabilizing rate regardless of the steady inflation rate, because attempts to keep it lower only lead to accelerating inflation and higher expectations, which become untenable.
That rate became known as
The unemployment rate at which inflation is constant, where actual inflation equals expected inflation because the bargaining gap is zero, became known as the inflation stabilizing rate of unemployment. Sometimes you hear it called the non-accelerating inflation rate of unemployment, NARU, or previously Friedman called it the natural rate of unemployment.
And this helps explain the disastrous experience of the 1970s perfectly, doesn't it? Countries tried to keep unemployment low, perhaps still believing in the old stable trade-off.
And they ended up with runaway inflation instead of just a slightly higher but stable rate. Expectations took off.
But the 1970s also threw another wrench into the works. Something the simple Phillips curve, even with expectations, struggled with initially.
Supply shocks.
Yes, that was the other major complication. Things like the huge increases in oil prices we saw back then.
The oil embargoes.
Classic and devastating examples.
No.
Your sources discuss how inflation isn't just about aggregate demand pulling things up via the bargaining gap. It's also influenced by firms' costs, pushing prices up, cost push inflation.
Right.
A firm's unit costs include not only labor costs, but also costs of energy and imported materials, like oil or metals or computer chips.
And if the price of a key imported material like oil spikes dramatically, as it did in the 70s.
Firms face significantly higher production costs. To maintain their profit margins or markups, they have to raise their selling prices.
Okay, so that's a direct hit to the price level. It is. But it also interacts with the labor market dynamics we discussed. In our labor market model, higher costs for imported materials mean that for any given final price the firm charges, the share left over for workers' real wages is smaller.
Less pie available for wages.
Exactly. This effectively shifts the price-setting curve downward in the labor market diagram. The affordable real wage is lower.
So what does that mean for the bargaining gap?
It means that even if unemployment is at the previous equilibrium level, where the bargaining gap was zero, the downward shift of the price-setting curve means the real wage workers were expecting or demanding on the old wage-setting curve is now above the new lower real wage firms can afford.
So a positive bargaining gap opens up, even without a boom.
Precisely. A positive bargaining gap opens up spontaneously, driven purely by the adverse supply-side cost shock, not by low unemployment or excess demand.
And that triggers the same wage price spiral.
You got it. This positive bargaining gap, created by the supply shock, kicks off the same mechanism. Workers see prices rising, initially due to the oil price hike, and demand higher nominal wages to compensate. Firms, facing both higher oil costs and higher wage costs, raise prices further, and the spiral takes hold, driven now by both cost push and subsequent wage demands.
And the really nasty consequence of this type of shock is stagflation, that awful combination where you have both high inflation and high unemployment happening at the same time. The simple Phillips curve, suggesting a trade-off, just couldn't explain this.
But the model incorporating expectations and supply shocks can. The shock itself directly creates inflation via the cost increase and the induced bargaining gap. And crucially, the shock might also increase unemployment.
Also,
Well, policymakers might react to the inflation by tightening monetary policy, raising interest rates, which deliberately slows the economy and raises unemployment to fight inflation. Or the supply shock itself, by reducing the real purchasing power of incomes or disrupting production processes, could directly depress aggregate demand and output, leading to layoffs.
So you get hit from both sides, higher prices and fewer jobs.
Exactly. The UK data plot you mentioned, figure 15.13, visually shows this painful period of rising unemployment alongside high and volatile inflation in the 1970s and early 80s. It wasn't a neat curve anymore.
The sources even provide the math behind this, breaking down unit costs into labor costs and imported material costs, weighted by their share. It shows how an oil price shock logically translates into broader inflation.
It really drove home the point that inflation wasn't solely a demand pull phenomenon tied to low unemployment. It could also be cost-push inflation stemming from external supply-side shocks. This significantly complicated the job of policymakers. No easy menu anymore.
So given this much more complex picture, the trade-off may be existing in the short run but influenced by expectations, and the whole curve shifting due to supply shocks. How do central banks and governments actually try to manage things today? What are their main tools?
Well, the primary goal for most major economies today, as your sources consistently note, is maintaining low unemployment alongside low and stable inflation, typically targeting around 2%. The two main levers they use are monetary policy, usually controlled by the central bank, and fiscal policy, controlled by the government, like Congress and the president in the U.S.
Monetary policy is mainly about setting the key policy interest rate, right? The rate at which commercial banks borrow from the central bank or lend to each other overnight.
Yes, that's the key operational tool. Your source material, figure 15.14, is great for this. Details the transmission mechanism, how changes in that one short-term policy rate ripple through the entire economy. It's not instant magic.
How does it ripple?
Well, the policy rate influences other market interest rates, like longer-term loan rates for businesses, mortgage rates for households, interest rates on corporate bonds. These rates, in turn, affect asset prices, think bond prices, stock market valuations, maybe even house prices.
Higher interest rates generally make borrowing more expensive and can depress asset values, right?
Exactly. And those changes in borrowing costs and overall wealth via asset prices then directly impact aggregate demand, the total demand for goods and services in the economy.
Okay.
Higher rates mean firms invest less in new equipment or buildings, households borrow less for big purchases like cars or houses, maybe cut back on credit card spending, and potentially, as we'll see, it can affect exports too. Lower rates do the opposite, stimulating demand.
And that change in aggregate demand then affects how much firms produce, how many people they hire, so it impacts the level of unemployment.
Right.
And eventually, back through the Phillips Curve mechanisms, we discussed the bargaining gap pressure and influencing expectations. It influences the rate of inflation. It's quite a complex chain reaction.
It is. It takes time, and there are uncertainties along the way, but that's the basic channel. The other main tool is fiscal policy, the government's decisions on spending and taxation.
So building roads, funding schools, changing tax rates.
Exactly. When the government increases its own spending on infrastructure, defense, social programs, or cuts taxes, leaving more money with households and firms, it directly injects demand into the economy. This boosts aggregate demand, often amplified by the multiplier effect, where that initial spending leads to further rounds of spending by others.
So policymakers use these tools, monetary and fiscal, to try and stabilize the economy, sort of lean against the wind.
That's the idea, counter-cyclical policy. If the economy is hit by a negative demand shock, like a sudden fall in business confidence and investment, the source uses the U.S. example after the tech bubble burst in 2001.
Right, I remember that.
Aggregate demand falls, leading to rising unemployment and potentially falling inflation or even deflationary pressure.
So what do they do?
In that scenario, the central bank typically cuts interest rates sharply to make borrowing cheaper and encourage investment and consumption. The government might also use expansionary fiscal policy, like the tax cuts and increased government spending seen in the U.S. during 2001-2002, to directly boost demand and cushion the downturn. Your sources illustrate these policy responses well.
Okay, and conversely, if the economy is overheating, aggregate demand is too strong, unemployment is very low, maybe below that inflation stabilizing rate, and inflation is starting to pick up speed.
Then the central bank usually steps on the brakes by raising interest rates.
To cool things down.
Exactly. This makes borrowing more expensive, cools down investment and consumption, dampens aggregate demand, and ideally puts some upward pressure on unemployment, moving it back towards the stabilizing rate, helping to close any positive bargaining gap and bring inflation back down towards the target.
But using these tools isn't always straightforward. There are significant challenges and constraints. You mentioned the zero lower bound, ZLB, for nominal interest rates earlier. That seems like a big one.
It's a major constraint for monetary policy, especially in recent decades. If the nominal policy rate hits zero during a severe recession, the central bank simply can't cut it any further using conventional means.
And that limits how low the real interest rate can go.
Precisely, because the real interest rate is the nominal rate minus expected inflation. If inflation is already very low or even negative deflation, then even a zero nominal rate might mean the real rate is still zero or positive.
And you often need a significantly negative real interest rate during a deep slump to provide enough stimulus to get borrowing and investment going again.
That's the problem. Hitting the ZLB limits the power of conventional monetary policy right when it might be needed most. This experience, particularly after the 2008 global financial crisis when many central banks hit the ZLB, is precisely why some prominent economists argued for a slightly higher inflation target, maybe 3% or 4% instead of 2%.
To give themselves more room before hitting zero.
Exactly. A higher average inflation rate means that even when the nominal rate hits zero, the real rate can be more negative, providing more stimulus potential. Example, if expected inflation is 4%, a 0% nominal rate means a manic 4% real rate. It's a debate that's still ongoing.
Your sources also briefly mention potential dangers of fiscal policy, though they don't go into huge detail.
They do raise the issue, often related to increasing government debt. While fiscal stimulus can be absolutely crucial, especially when monetary policy is constrained by the ZLB and might be the only effective tool left.
Like in 2009 or 2020.
Good examples. But sustained large deficits year after year can lead to a buildup of government debt relative to the size of the economy. Managing this debt can become a challenge down the road, potentially requiring future tax increases or spending cuts, or raising concerns among investors about long-term fiscal sustainability, depending on the level of debt, interest rates, and economic growth prospects. So while it's a powerful tool, it's not a free lunch. There are potential long-term consequences to consider.
And for countries that have their own currency and let it float, there's an additional channel for monetary policy to work through the exchange rate.
Yes, this is an important transmission mechanism, especially for smaller, open economies. When a central bank lowers its policy interest rate,
Money flows out, seeking higher returns elsewhere.
essentially, yes. Domestic assets become relatively less attractive compared to assets in other countries offering higher interest rates. Foreign investors are less inclined to hold your currency to buy your bonds or other assets. This reduces demand for your currency on international foreign exchange markets.
Causing the currency's value to fall depreciation.
Exactly. Your currency depreciates.
And how does that help the economy?
A depreciated currency makes your country's exports cheaper for buyers in other countries, boosting demand for your products abroad. At the same time, it makes imports from other countries more expensive for people and firms in your country.
So they buy more domestic stuff instead.
Correct. More expensive imports encourage domestic buyers to switch to domestically produced alternatives. Both affects cheaper exports and more expensive imports. Switching demand homeward increase your country's net exports minus imports, which is a key component of aggregate demand.
So monetary easing can stimulate the economy, not just through lower borrowing costs domestically, but also by boosting demand through the exchange rate channel. The Australian dollar example in your source illustrates this dynamic quite clearly.
It does. It's another way monetary policy impacts aggregate demand and ultimately inflation and unemployment.
Okay, so the turbulent economic times of the 1970s, with stagflation and the Phillips Curve seemingly breaking down or shifting unpredictably, forced a major rethinking of how macroeconomic policy should actually be designed and conducted.
It really did. It forced economists and policymakers to confront the flaws in the simpler, earlier framework. The insights from Friedman and Phelps about the crucial role of expectations, combined with the hard experience of supply shocks, convinced many that attempting to actively exploit a supposed stable trade-off between inflation and unemployment was a dangerous game.
Why dangerous?
Because, as we saw, trying to keep unemployment below its sustainable, inflation stabilizing rate didn't just lead to higher inflation, it led to accelerating inflation as expectations ratcheted upwards. That ultimately proved far more damaging to the economy.
This led to a major shift in policy thinking and practice, especially in the late 1980s and 1990s, toward frameworks like inflation targeting.
Yes, central banks were increasingly given a clear public mandate,
Right.
use monetary policy tools, primarily the policy interest rate, to keep inflation close to a specific, low, and stable target, typically around 2% in most advanced economies.
And crucially, hand in hand with inflation targeting came the push for central bank independence. Governments started granting their central banks greater autonomy, insulating them from day-to-day political interference.
That was a key institutional change.
Why was this considered so important? Why take this powerful economic lever away from elected officials who are accountable to voters?
It really comes back to that political pressure we saw illustrated by the Helmut Schmidt anecdote. Politicians face strong short-term incentives, especially as elections approach, to stimulate the economy and push unemployment down now, even if it risks higher inflation later after the election.
The temptation is always there.
It is, but as the theory and experience showed, consistently giving in to that temptation, trying to push unemployment below the inflation stabilizing rate, leads to accelerating inflation, which ultimately harms economic stability and everyone's welfare.
So an independent central bank with a clear mandate for price stability and shielded from those short-term political pressures
Is theoretically better positioned to focus on the long-term goal of keeping inflation low and stable. They can make the necessary, sometimes politically unpopular decisions, like raising interest rates to cool an overheating economy, without fear of immediate political retribution. The goal is to anchor inflation expectations firmly around the target.
And does the evidence suggest this works?
The evidence is pretty compelling, yes. Your source provides a striking chart, figure at 15.20, showing a strong negative correlation across many OECD countries. Those countries that granted their central banks more independence in the mid-1980s tended to experience significantly lower average inflation rates over the preceding decades, from the 60s to the 90s. It suggests independence helps deliver price stability.
This combination of institutional change, independent central banks with clear inflation targets, and the refined theoretical understanding of inflation dynamics is often credited with contributing significantly to the period known as the Great Moderation.
That's right, roughly spanning from the late 1980s up until the 2008 financial crisis.
What characterized the Great Moderation?
During that period, major economies generally experienced significantly lower volatility, fewer wild swings in economic output, inflation, and unemployment compared to the very turbulent 1970s and early 80s.
Things felt calmer.
Much calmer. And importantly, even when faced with new supply shocks, like rising oil prices again in the 2000s, central banks operating under inflation targeting frameworks seemed much more successful in managing the inflationary impact without triggering major recessions or allowing expectations to become unanchored, unlike the experience in the 70s. Figure 15.12 in your material contrasts the relative stability of this later period with the wild swings of the 1970s quite effectively.
So under an inflation targeting framework, the policy reaction function is clear. If the central bank sees signs of overheating and employment falling perhaps too low, aggregate demand looking too strong, and inflation starting to creep up above target,
signaling a potential positive bargaining gap and the risk of rising expectations.
they know it's time to proactively raise interest rates to preempt a larger inflationary problem.
Exactly. And conversely, if aggregate demand weakens, leading to rising unemployment and inflation starting to fall persistently below target, suggesting a negative bargaining gap.
They cut rates to stimulate the economy and nudge inflation back up towards the target. Figure 15.21 in your sources uses indifference curves and the Phillips Curve framework to visualize this policy, approach the central bank constantly adjusting rates to try and guide the economy towards that sweet spot of the inflation target at the inflation stabilizing unemployment rate.
Okay, now bringing this right up to the present day, your sources touch on some really interesting recent observations that have sparked a lot of debate and head-scratching among economists.
Absolutely. The last few years have been unusual.
Since, say, mid-2020 in the U.S., we saw inflation surge dramatically, reaching levels not seen in decades. But initially, this happened without unemployment falling to the super low levels that, based on historical Phillips Curve estimates, would have seemed necessary to generate such high inflation.
Right. The relationship looked different. And then more recently, as central banks hiked rates aggressively, inflation has started to come down quite significantly. But unemployment, while ticking up slightly, hasn't surged to the high levels that some feared might be necessary based on past disinflations.
Exactly. It hasn't followed the old script perfectly.
This has led many economists and analysts, as mentioned in the Cleveland Fed and Niskanen sources you shared, to suggest that the Phillips curve has become flattened.
Yes, that's the term you hear a lot. A flatter Phillips curve essentially means that the observed short-run trade-off between unemployment and inflation appears weaker than it used to be. A given change in the unemployment rate seems to be associated with a smaller change in the inflation rate compared to, say, the 1960s or 70s.
The marketplace source echoes this, pointing out that the stability of the Phillips curve has not been great for at least 20 years, suggesting it's perhaps best viewed today more as a general conceptual framework about pressures in the economy, rather than a precise, stable, quantitative relationship you can rely on year after year.
I think that's a fair assessment. It's a framework, not an iron law.
And if the Phillips curve is indeed flatter, the crucial question becomes why? What's causing this apparent weakening of the link? Your sources discuss a couple of key potential reasons.
Yes, and the why really matters for policy. One prominent argument, particularly emphasized by the Niskanen source looking at the recent U.S. experience from 2020-2022, is that inflation expectations remain well anchored.
Meaning that even though actual inflation shot up really high for a while, people, workers, businesses, financial markets still largely believed that the central bank was committed to and would eventually succeed in bringing inflation back down to its 2% target over the medium term.
That's the core of the argument. If expectations are firmly anchored like that, people are less likely to automatically build the current high inflation rate into their long-term wage demands and pricing strategies. They sort of look through the temporary spike.
So it doesn't feed on itself as much.
Exactly. It helps break that dangerous, self-reinforcing wage price spiral that caused inflation to accelerate so persistently in the 1970s when expectations did become unanchored. If expectations stay anchored, the inflationary impulse from temporary factors like supply chain disruptions or even a period of low unemployment is more contained. It doesn't necessarily translate into persistently higher inflation.
And the Niskanen source argues this anchoring is why, despite the recent huge price surges, the U.S. hasn't really seen a return to true 1970s-style stagflation, meaning high and accelerating inflation alongside persistently rising unemployment. Instead,
as inflation has come down more recently, unemployment has risen only modestly. It looks more like a traditional Phillips curve movement down along a relatively flat curve, rather than the whole curve persistently shifting upwards due to unanchored expectations, which is what happened in the 70s. Anchored expectations make the curve flatter and prevent the upward spiral.
That makes sense. The Cleveland Fed source also mentions other potential structural reasons for flattening, like maybe changes in global competition affecting firms' pricing power, or changes in how sensitive household spending is to interest rate changes, though that gets pretty technical.
There could be multiple factors at play, and economists are actively researching them. But what's really important, as the Cleveland Fed source rightly stresses, is that the reason for the flattening has significant implications for how monetary policy works and how costly it might be to control inflation.
How so?
Well, if the flattening is primarily because expectations are strongly anchored, thanks to decades of credible inflation targeting by the central bank.
That sounds like good news.
It could be. It might suggest that the central bank can bring inflation down to disinflate the economy with a smaller increase in unemployment than was required in the past. The sacrifice ratio, how much unemployment has to rise to reduce inflation by 1 percentage point, might be lower. Disinflation might be less painful in terms of lost jobs and output compared to, say, the very costly Volcker disinflation of the early 1980s, which required inducing a deep recession specifically to break those entrenched high inflationary expectations.
But what if the flattening is due to other, less understood structural changes in the economy?
Then it could simply mean the link between the central bank's policy actions, like raising interest rates, and the resulting inflation outcome is less powerful or less predictable than it used to be. They might have to raise rates more or for longer to get the same effect on inflation. It could add another layer of uncertainty to the already complex task of managing the economy.
So the interpretation really matters.
Absolutely. It underscores that while the Phillips curve provides an essential conceptual framework for thinking about inflation, unemployment, and policy, it's not a stable mechanical dial that policymakers can just set and forget. Its shape and position are constantly influenced by expectations, by global supply conditions, and potentially by deeper structural factors in the labor market and product markets that can evolve over time.
Okay, so bringing this really fascinating deep dive to a close, we started with that appealingly simple idea that A.W. Phillips found in the data nearly 70 years ago what looked like a stable, predictable trade-off between unemployment and inflation. a clear menu for policymakers.
It seems so clear back then. But we've journeyed through decades of economic thought and often painful real-world experience to see how profoundly that simple picture became more complex, more nuanced.
Yeah.
The constant tug-of-war over how to divide the economic pie between wages and profits, captured by the bargaining gap. The absolutely critical role of people's beliefs about future prices, their expectations, and those unexpected external shocks to supply chains and input costs. All these factors showed that inflation and unemployment can move in much more complicated ways than the original curve suggested.
Sometimes even rising together in that dreaded stagflation.
Exactly. So today, policymakers, particularly independent central banks, armed with inflation targets and a better understanding of these dynamics, use tools like interest rates, trying to navigate the complex transmission mechanisms to achieve that elusive balance. They're still aiming for stable prices alongside something like the inflation stabilizing rate of unemployment, but they know it's a much harder balancing act.
And the material you shared really highlights some crucial lessons learned along this historical path. One is just the immense power of expectations. Keeping them anchored near the target seems absolutely vital for maintaining price stability.
Definitely key. Another huge takeaway is that there's no permanent exploitable trade-off, at least not in the way originally thought. Trying to keep unemployment artificially below the inflation stabilizing rate for too long leads not just to higher inflation, but to accelerating inflation, which is ultimately unsustainable.
Right.
And finally, it's clear that external events, global factors, and the underlying structure of the economy, things like energy prices, supply chains, competition matter just as much as the level of domestic demand in shaping inflation outcomes. Understanding all these multiple layers provides a far richer and more useful framework for analysis than just relying on that outdated, simple curve from the 1950s.
Which leaves us with a final thought to ponder, especially given this recent debate about a flattening Phillips curve and the different potential explanations for why that might be happening. Is it primarily about well-anchored expectations, or are there other deeper structural forces at play? Consider this. Does a flatter Phillips curve ultimately make it easier for central banks to achieve that twin goal of low unemployment and low stable inflation simultaneously, perhaps allowing them to run the economy a bit hotter without immediate inflationary consequences? Or does it simply make the link between their policy actions and what actually happens to inflation less certain, potentially requiring more forceful action when inflation does rise, and adding a new layer of complexity and unpredictability to the art and science of economic management?
That's the multi-trillion-dollar question, isn't it? And something central bankers and economists are grappling with right now.